It's good to have you back with Corey and I for some ultimate options. This will be a shorter lesson, but it's a vital lesson. And again, I'm trying to think of all of the things I wish I would have known before I started trading options. You know what I mean, Corey?
Absolutely. Having a strategy, a game plan. I mean, it seems pretty obvious, but I don't know if it was the same for you, but when I first started, it was just kind of, I thought I'd go out there like the wild, wild west and just start shooting and it would work out. And it doesn't really work that way. You got to have a good strategy, a good game plan, just like any business. They're going to write up a good business plan to get started.
So, how about that?
Same thing. Yeah.
This was me when I first started, man. I just was trading options arbitrarily. It wasn't really part of a great plan. And it's one thing to just know how to do an iron condor, right? It's another thing to know, okay, well, how does this fit into my ultimate goal? How big do I go? How many do I do? How often do I trade? And, this course really is going to center on the techniques, right? How do you do it? How do you manage the risk? But it's not going to be as effective unless it's in a real organized attack. And that's going to be different for everybody. So I'm going to give you some guidelines and some things that are going to make you feel really good about your trading plan, feel really organized. And the less frustration a guy has about stuff like that, the more he or she is going to be able to trade well. So again, this is educational. I'm going to actually recommend here in a little bit about the team members. Here it says, decision to place trades, including stops and options, a personal decision that made through research. Now watch this, and the engagement of professional assistance to the extent you believe necessary. That can be a good thing and it can be a bad thing. So we'll talk a little bit about that. So the basic thing here is we want to go from a job basically with guys bringing us work and making money with work by making money with stuff like this, right? I mean, that's really what we're after. And we have these 4 asset classes. Maybe you have a business. Maybe you got some real estate. I love real estate. I seek to invest in more real estate. I think it's a great way to short the dollar. I have great friends that are in oil that have done very, very well. And I'd like to do some of that. This is the one I'm weakest in personally. And then we have our paper, which we're doing here. And so this all starts with a financial statement. It really does. Where we begin with the end in mind. And Corey, you can talk about, you talk about short-term goals and long-term goals, and I'm going to talk about priorities, so we'll both be able to chime in here. But the first priority is to take care of self. Okay? And what this is a cash flow issue. To take care of yourself is a cash flow issue. If you have a passive income that is greater than expenses, you're going to be able. You don't need a job. You can take care of yourself. You can do this. The second is to take care of others, like your family. So once you get yourself taken care of, wouldn't it be nice while you're alive to help? I've got a great friend who has made more money than his father. And if I had a rich dad growing up in my life, this guy was a stockbroker that worked for Dean Witter, which became Morgan Stanley later on. And when I was first married, Corey, he was a great rich dad to me. He sat me down, and this was really, really cool. He didn't teach me this, okay, but he did teach me a little bit about self-sufficiency. He sat my wife and I down when we first got married, and he said, "So you want to be rich, huh?" This is before Rich Dad, Poor Dad was written. This is before, this is 1993. And he said, "So you guys want to be rich, huh?" And he says, "Well, you got to really, really want to be rich. Everyone says they want to be rich." And what he meant by that is, am I willing to sacrifice buying liabilities to buy assets, is really what he was saying. Do you want
sacrifice what you want now for something better in the future?
And so we had and so he said don't, he wasn't mean like, Robert's rich dad, but his name was Lynn, and I owe him so much today. Is he kicked us out of he said, "All right, you can't invest if you can't save." Now, I don't like saving money because if I put $1 here, it's going to go down in value, but I can't turn that into an asset unless I allocate it to that instead of a doodad, right? So I can either buy doodads, or that's my choice. I can buy a doodad, I can go and buy a car, at $500 a month car payment, or I can put some money here and then put it in stock. So when I get an income of $500, let's say, I can either choose to send that out through, a car and make a car payment, or I can send that income to an asset that can send me more money, more. And so that's the first choice you have. And one of the things, so the first thing he said, what's your savings goal? And we decided to be really aggressive with it. We actually said, as a young couple in 1993, working jobs, this was hard to do. But we said, we're going to save $500 a month. And at the end of one, he says, all right, come back and see me in a year. He literally said that was it. There was no more talk about stock. There was no more talk about investment. He says, come back and see me in a year. So 1 year later, we walked back in his office and we had $6,000. And that was a huge lesson. The second thing he says, if you have $100,000 in the bank, you can quit a job. If you have $100,000 in the bank, you can quit a job. You might not be able to go without a job, but if your job sucks, you get $100,000. You can tell your boss where to go.
You can quit it.
That gives you time to find another job, right?
But that's brilliant.
But so he was really talking about saving and net worth, but really it's about cash flow. And when a passive income, the first thing a guy probably wants to do is he or she wants to get a passive income that's above expenses, because then you can quit a job and not have to find a new one. And it doesn't matter what your net worth is. So, if you have expenses and we know this, we don't need to spend a lot of time. It's, expenses of $5,000, you get a passive income from your assets of $6,000. Now you've taken care of yourself. Okay. The next thing is this grows. As the cash flow grows, you can take care of your family. Okay, and then number 3 is after that, you can leave what's called a legacy for others, right? For the community. Guys like Warren Buffett do this. Bill Gates does this, right? And you and I will probably never be as big as Warren Buffett or Bill Gates. I can almost assure it. But we can still give to our community, and we can create cash flow after we're gone. In other words, after we die, we can pass assets down. I cannot take a master's degree and pass it on to my son, but I can take a stock portfolio and pass it on to my son, right? Or a real estate portfolio. And we'll talk about education in a minute. So when you have your goals in mind, you sit down and the first goal is usually passive income, greater than expenses, so we can get a cash flow here, to where the passive income is greater than the expense number. We've got a lot more money coming here than here. Well, that's done in 4 ways. It's done with business. It's done with real estate. It's done with paper assets like stocks and options. And it's done with commodities like, oil and stuff like that. Your biggest liability is taxes. Okay, that you spend more money on that than anything else. And so the idea is to create a plan, begin with it in mind, create a plan where you get income from these things going up and taxes have to go down. They absolutely have to go down. And what our job is to help you with this one, is to say, to help you with this. But this should fit inside of this. And when you make the money, let's say you go make $1,000 on a trade. Okay, what are you going to do with that $1,000? Are you going to spend it as part of your income? Are you going to invest it in maybe some real estate or maybe some gold and silver? Or maybe you're going to use that as seed capital to start a business, or maybe you're going to raise capital and increase your debt. Who knows? But what to do this $1,000 must be part of a plan. Okay, we have to plan what we're going to do with this money, where it's going to go and what it's going to do. And that leads to this. You want a money goal. You want to have a money goal, and you probably also have a time goal. So what that means is I want a cash flow of X. Maybe you want $10,000 a month in passive income. And I want that by the time, I'm 55 years old or whatever it is, or 45, or whatever that goal for us would be. depending on your age and where you are. So the problem with these two, Corey, is this: what percent return can you get, and what type of compounding can you do? And when you talk about compound interest, you have money, you have the rate at which you're accelerating, and you have the amount of time in which you get that rate. So this is the amount you start with, right? This is the performance, and this is how long you do it for, and you can compound your way, to a real big portfolio. Compounding graphs look like this. So talk to me about compounding for a minute.
Yeah, I mean, compounding, I think it was Einstein called it the eighth wonder of the world. It really is an important concept in trading, investing, and making money generally. You've probably read this book, The Richest Man in Babylon.
Yep.
I read it years ago, and the concept is brilliant, which is, you have this money that's making money. If you can now have that compounding, so your money that's profit is making additional profits. And this is how the rich get richer, frankly, is just compounding. So if I make $1,000 and then I turn around and make 10% on that $1,000, now I just made $1,100, right? My profit was able to generate more profit because my profit made an additional 10%. That extra $100 came from that. And so when you're trading and when you're getting involved in the markets, you want to be, there's kind of a growth and an income phase. Yeah. And growth happens more early and income happens more later in life as a general rule. But that's kind of how trading tends to work, where a newer trader is going to have a combination of growth and income, but they might be putting on some trades where if you get a little bit more aggressive, you can get greater rates of return, but you can also have bigger drawdowns. So my word of caution is always, don't try to grow too fast, too quickly. Make sure that whatever you do, your risk is the most important element. Make sure it's manageable and it is not your position sizing. You're not taking on unnecessary risks, too big of risks and that sort of thing. Because my experience has been the money will take care of itself. But in the world of finance, that time component is where people get frustrated. Mm-hmm. People want to be a millionaire yesterday. They don't want to be a millionaire tomorrow. And so it's kind of that concept of, in order to allow compounding to work, you start where you're at, you start generating positive returns, and maybe they're not the returns you want today, but here's the good news. You're going to be a better trader a year from now than you are today. So whatever rate of return you're making today, you should, over time, be able to generate even better returns in the future. You're going to keep getting better and better at what you're doing. And then if you allow time to work and that compounding to work, it's like magic. It really is. I set some goals early on. My wife and I, we were married in our 20s, and I set a goal early on. My first home, I said, I'm going to pay this thing off with trading profits before I'm 30 years old. And my whole philosophy was, I'll always have a mortgage, but if I could pay off my first home, then I could rent it out, get a mortgage on a little bigger sized home, and I could have the income from that pay off my mortgage on the second home. And then once that one's paid off, I could even upgrade and so on. And so that was, I don't know if that's a great strategy, but that was my strategy, right? And so I did unintentionally something that's very good, which is making your profits stick. Putting your profits, Andy mentioned this, putting your profits into other asset classes. You can generate profits from your cash assets and put them into real estate assets. So you might be saving for a down payment on a second home that you're going to rent out and generate positive cash flow on it. And now it's cash flowing income, and maybe you're going to take the money that's coming in from the real estate and start pouring it right back into stock. So your stock paid for your initial investment into real estate, and then the income from real estate you put right back into stock, and you're making your money stick. You're building wealth. And that's That's the key. So money, rate, and time. It takes some time. Be patient, and you're going to get better and better at this and get better returns as years go by.
Now, this is the hardest part, and this is what we need to talk about with options trading, is this right here is this rate, okay? So people say, how much money should I start with? Well, you got to start with what you have, okay? And to do this in an options account, $2,000 is a minimum, okay? And you start there. Okay, time, everyone wants this to be shorter, not longer. So, this right here you can't get back, and obviously people want it sooner. But you really can't have the plan for the future unless you know what your rate's going to be. Most advisors will sit you down and they will assume, which is a really scary word, they'll assume a certain rate. And so it's very, very hard to trade options without having an idea of what type of rate of return you want to have as you go into this and what you're going to go for. And the question that I hate more than anything else, because it's a liability for me to answer it legally because I'm not licensed to do so, as your teacher, there's no suitability interview here. And yet I care very much about it as a teacher, is, Andy, what kind of rate should I expect to get? What kind of rate? How can I begin with the end in mind and compound to a high value asset column that spits out lots of cash with positive cash flow so I can retire? How do I get there? Well, I've got to know, get a feel for anyway, what this rate is. So let's talk about different kind of rates. Now here's at the upper end, you got Ray. It used to be Soros. Soros is like number 2 now. He's still doing well, but Ray is just crushing it for his clients. And, it's not like his portfolio gain has gone through the roof, right here. But, this right here is called the Sharpe ratio. And this is what I really want to highlight right here, is the Sharpe ratio is a risk evaluation. Now, you don't need to figure out what your Sharpe ratio is specifically right now, I wouldn't say. Maybe down the road you can get that sophisticated. But this tells you really how much reward you got per risk taken. Okay, you can get massive reward, and maybe you took small risk. That's an awesome Sharpe ratio. But if you take, if you get just tiny amounts of money and you're taking massive risk, then that's a really lousy Sharpe ratio. Sharpe. And so the Sharpe ratio starts with, basically in its formula, it's kind of like a government secured, like a treasury, right? Like a bond. And they assume that's zero risk. And then you work up from there in the formula. And you're really comparing every investment in essence, and you know more about this than I do as an options principle, Corey, but you're really saying, compared to buying a treasury bond that doesn't give me anything hardly, well, those are considered risk-free. Yeah, tongue-in-cheek, yeah. Risk-free. How does my investments return and risk compare to that of a risk-free bond? Do you want to say anything about Sharpe ratio quick?
Yeah, that's it. I mean, they consider investing in a U.S. Treasury risk-free. So what's my return compared to that? If the risk-free rate of return is 4%, how am I doing on an annualized basis compared to that number? Well, if I generate a 20% return, then I've done 16% better, and that will factor into my Sharpe ratio, right? I'm beating the risk-free rate of return. Now, if I consistently get worse returns than the risk-free rate of return, then my Sharpe ratio is going to be really bad, right? So I have to generate profits, first of all, in order to have a good Sharpe ratio. But something you said was very, very important. The amount of risk taken to generate the profits. I've always been amazed at how you don't really have to risk a lot to make stellar returns, to make good returns, to manage your risk appropriately. You don't have to take excess risks. And in fact, taking too much risk is one of the quickest ways to actually end up in a bad situation. So wherever you think you should be at in risk early on, take that down. And of course, you're always going to practice trade. You better be practice trading everything. Get a sense of how your system's working. across 20 trades and then 40 trades and then 60 trades. How am I doing, and what types of drawdowns or risks am I taking per trade? Because some trades are going to lose, and that's fine. Not every trade needs to be profitable, but what type of returns am I generating versus what types of risks am I taking? If I said that two traders both had a positive 20% return, you would say, well, they were equally good. And I'd say, no, that's not true. Which one took less risk to get their return? They did a better job. And so that risk component, if you'll focus on keeping your risks small and keeping them contained, it's amazing how good your Sharpe ratio becomes and what type of profits you can make. But if you let that risk get out of control, that's the big pitfall, right? So not controlling your risk. And that's all done through position sizing, risk management. So we get to determine, we know before we get into the trade how much we can lose. And we'll show you that with each strategy. This strategy can lose X amount in this example. And so we'll give you some of those breakdowns.
Now, let's talk about risk a little bit, because it's essential when we're talking about return in your overall plan. Now, the way the dogma works usually is something like this, is I might say, okay, this is risk over here, okay, and this is reward. And you might have seen me do this before, but this is very important, is if you're an investment-centered guy, it's going to look like this. The more reward you try to get and go for, the higher and higher risk you take. And so what most people do when they start is they start off with with lower risk stuff. So for example, this might be like, a bond fund, really diverse, government bond type fund. They consider that. But with that lower risk, its ability to get you towards your goal takes longer, okay, because the rate is lower. So you're looking at a longer time horizon. Then they'll put stuff like here, which might be considered, some mutual funds. I think they're incredibly risky. This is not my philosophy. I'm just showing you what most people say is a mutual fund. Okay, then you get in here into stocks, and then you get in here in what would be considered options. And that's the dogma that most people are stuck with. And so if a person is not an active investor, if they're just a passive investor to where they are just going to park money and stuff and hope it does well over time, and you're kind of a John Bogle fan, and you're just going to follow indexes and, basic financial planning, you're just going to have to wait and hope that the economy treats you well. And I think this is riskier than people think. But if you look at guys like Dario and Soros and Buffett, you're not talking about investments, you're talking about investors now. And so the idea is great investors get great returns. Yeah, great investments get great returns, but great investors get great returns. Because, every time you go with an investment-centered attitude of saying, well, I'm just going to trade options. Well, yeah, you'll have more rewards, but you will get bit by risk. So another way to look at this right here would be this, is let's put our risk here, and let's put education here. Okay, now watch this, education, and let's put practice, right? And let's put discipline, okay? And let's put all that right here, education, practice, and discipline. Now we're working on the investor, not the investment, and you're absolutely going to see examples of risk going down like this, as rewards get higher, as risk will go down as education, practice, and higher. So as you do these things right here, you can begin to tweak this pyramid a little bit to where, it can maybe look like this and even, look like this compared to what other people. If you look at George Soros' stuff, I haven't seen his portfolio, but, Buffett hangs out a lot right here. This is where Buffett hangs out, and Soros and Buffett hang out here. They make billions on options, and Buffett owns a lot of stock. He owns a lot of stock. He does not diversify as much. And so the great investors do wind up here. But here's the big key to this, okay? And I'm going to tell you right now is there are 4 pillars. There's fundamental analysis and technical analysis. And the people that stop there will still have a lot of this because they don't have the risk management. And as Corey and I have talked about, is if you will manage your risk every time with position sizing, adjustments, hedges, and really control that risk, then you have an opportunity to make that money stick. And over time, you can see your returns get higher and higher and higher. But please don't expect of yourself to go out and go crazy. Look, what you really want to do is move over here, and this will take time, energy, and practice. So I imagine if you sat down with a financial advisor, you would probably start here, and you would probably be trading on paper first, which has 0 reward and 0 risk. I don't know what kind of Sharpe ratio that is, but a paper account, when you start, a paper account is going to have 0 reward and it's going to have 0 risk, but your education will go up. So until
that's a perfect Sharpe ratio for the beginner.
Right there, infinite, undefined, whatever, right?
Yeah.
And so a person probably is stuck with some traditional type of investment-centered approaches until they get smarter. Now, so your job is to get smarter. Now, we got to choose a team as part of this plan. I don't think you should trade options without a team. If you really want to be wealthy, these people will meet with you. They're not that expensive. And I'm gonna lay out some team members for you. And I did this in the 4 pillars, and I'm gonna do it here as well. Okay, team members. Okay, first is you want to have a bookkeeper. I don't know how to spell bookkeeper. It's one word, but I'm going to use 2 here. You want to have a bookkeeper. And what the bookkeeper will do is help you see this better than you can. Income, expenses, assets, liabilities, net worth, and cash flow. Okay? A balance sheet actually doesn't look as simple as a Rich Dad one. A balance sheet is actually net worth minus liabilities equals assets is the way they do that algebra. But a bookkeeper is going to do this. And Robert and Kim Kiyosaki taught me this. They had a lady named Betty. The bookkeeper we have is a lady named Laurie. And that's a once-a-month meeting. Okay? So ask yourself this question. I'm telling you, it's an options course, but all this option trading, look, it's a once-a-month meeting. And you meet with them, I would recommend once a month. Sometimes it's a phone meeting. Laurie started out doing our business books and then another business books. And, we realized, we got to do what Robert and Kim said. We got to get her doing our personal too. And that's the biggest thing, is to keep track of that stuff, is bookkeeper. Okay. The next one is an accountant. You cannot have good accounting if you don't have good bookkeeping. Okay, I'm biased. I can't give recommendations, but a person you can talk to is Tom Wheelwright, and he is my accountant. I'll name names on that one. Your bookkeeper should probably be local. And he's expensive. He's more expensive than most accountants. So, you have to decide what that's worth to you, just to have a good team. But the reason the accountant's so important is taxes is your number one liability, and we want to have good planning. And he's not just an accountant; he's a good wealth strategist. So that's important. You've got to have an attorney on your team, especially if you're getting into real estate. It's probably, equally important because you can get sued for any asset class you have. You don't want to build all these assets and have them taken from you. And I have, a couple of different attorneys. I have a business attorney for contracts that I'm going to do as a businessman, but I also have an asset protection attorney And that's what Garrett Sutton does, is asset protection, to protect assets. And I spend a lot of money on all these things, but I'm telling you, you can do more as a team. And the reason people don't do this and get a good plan together is because they don't want to pay these guys, and they're stepping over pennies to pick up dollars. Okay. Another person on your team is your planner. It's nothing wrong with having a financial planner, like John McGregor or guys like that. But the planner is going to help you understand where all these assets fit, and your options trading that you're going to do in your asset column and the cash flow comes. Where does that fit amongst the plan, the overall plan? It is not my job to give you this plan. My job is to teach you how to do this option component right here and how to manage the risk of that. It's going to be your team's job to sit down with you and decide where this fits in the overall plan. And then also, keep seeking good teachers. My teacher, I have a bunch of them, but Noah is a great teacher. Corey, obviously, is a great teacher. Robert Kiyosaki is a great teacher. Than Merrill is one of my great teachers. I mean, I have more teachers than all these guys combined. And so you want to have great teachers and always be learning. You should not stop learning at any time. So that's a basis of your team. Okay. It's good to have a banker. I have a relationship with my banker. I have one person I work with at the bank. So if I am going to invest in something and I need an account set up to invest in that, the banker can do that too. You also need to have a brokerage, and it's a little tougher to get one person or brokerage you can talk to. But if you get a guy in a local office, for example, you go into whatever brokerage, those guys are great team members. And if you have names and faces and friendships and relationships with these people, because they'll become some of your best friends and some of the most precious and important people in your life. It'll enhance your circle of friends. These are people that you invite to your daughter's wedding, dude. I'm telling you. They're huge. If you're in real estate, awesome. Then you need to have an agent, and the team gets bigger and bigger. But the best way, I'm going to say this loud so it has the best way to go into options trading with a great plan and an overall wealth plan is to build this team and have them help you with that plan. I'm going to say that again. The best way to go into options trading, because we're about 2 more classes away before we do our first trade, is to go sit down with these guys and get a wealth plan and get these guys in place. As you grow more wealth, these guys will take more money from you. But when you first start, you'll be surprised at how little they'll take from you. Okay, your attorney will usually be a one-time thing. It's a little painful up front to get all your entities set up, but after that, the maintenance isn't that bad. Okay, so I'm going to say it again. The best way for you to have a great plan moving into this class is to get that team together. And I'm telling you, I said this kind of lightly in the 4 Pillars class. I'm screaming it now because doggone it, why take this class if you're not going to do it the right way? Yet another thing I wish I would have done when I first started trading options is to do it in the context of a wealth plan, of where it works and where the capital is and how it's protected, and insurance. That's another person that's on here is your insurance guys, right? Anything you want to say about that, Corey?
Yeah, just to your point, you can always do more as a team than you can do on your own. And you look at the really great franchises in sports, they have this culture of winning, this culture of team first, and
yep.
That's really the mentality. And when you go team first and you think in terms of I'm going to pick great people around me, it's only going to make you better. It's going to open up other opportunities because you're thinking about this from a stock perspective, but it's going to open up opportunities for you to get into real estate and have some people that have experience that you don't have in these other markets, other arenas that can coach you, that can help you along the way. So great coaches, great teammates. I mean, it's critical to long-term success.
Huge. Okay. So let's talk about this then, is once you get your goals set and you have this plan together, okay, and this is really what we've been, talking about here, is this comes from your team, okay, of building your plan. This is your accountant, this is your bookkeeper, this is your attorney, this is all these guys we talked about. This is what this presentation has been about. I know you want a passive income. I know that you want a passive income, bigger your expenses. Maybe you've already got that and you want to grow. I know you want to take care of your family, legacy, whatever your financial goals are. Those are pretty easy to outline. Okay, how to get that done? Where is the word options in this plan? Because you might have some real estate. Corey and I have real estate, business, commodities. Where does all this work out? Taxes. Where does the options fit in this plan? Well, that's where your team comes in. They'll do their part every time. They're not going to drop the ball because that's their job. They're getting paid to do it. So the last thing I'll say about this is, once you get this plan, this is where the execution comes. This is where you make it happen. And I will say that this is the biggest part I work on in my life, because I suck at it. Okay, make it happen. I'm just like you. Not you, Corey. I mean you listening to me and Corey. Make it happen. And I have more books. I'll bet I have more books on self-discipline, more books on habit, more books on action taking, more books on that than I do stock books. In fact, I know I do. Most recently, I did a book study with Ken McElroy from MC Companies, and he asked me to come down to his corporate event and teach for a couple days, and we did a book study with his company, and it was on this book, The Power of Habit, because it is your habits that will make this happen, and when you make this happen, it makes this happen. So reduce this down to the lowest form is people are creatures of habit, and the habit will determine on whether or not you do this stuff. And whether or not you do this stuff determines here. So this is the thing I would say is the deal. So Corey, give me your typical day in terms of as a trader. How often do you trade? What are some of your habits in trading?
Yeah, it's interesting because a lot of people think that trading involves a lot of time and a lot of work. And certainly I'm not lazy. I mean, I put in my effort and I certainly check things and whatnot. But, what's interesting about it is when I wake up, and I wake up pretty early, I check the futures markets. I check kind of what's moving the markets today. What are the things that are in the headlines that people are paying attention to? What might be, driving the market for the day. There's typically some themes, right? It might be earnings is the focus. It might be some central bank focus or something like that. So I kind of get a theme. And then, the market opens and whatnot, and I've already got a game plan of how I'm going to go about the day. I have kind of some ideas of things that I'm going to look at, because I've done some homework the night before, or on the weekend is big for me, where I'll go through charts and I'll kind of get an idea of what I want for the week ahead. So I check the markets a little bit. My normal trades, I like to put on later in the day. So the stock market opens at 9:30 a.m. Eastern time. It closes at 4 o'clock p.m. Eastern time. And I like to do most of my trading before the close. So at about 3 o'clock p.m. Eastern time is when I'll actually start making changes. And so if I'm busy for most of the day, I could literally wake up early, kind of get a sense of what's happening, and then almost ignore the market for multiple hours, check back in late in the day, in the trading day, do a couple of trades that triggered my levels, and be done. I mean, I can have a 30-minute day or a 1-hour day. So I didn't spend a lot of time in that day doing a lot of things. And I don't sit in front of my screen watching the prices go up and down and up and down.
No.
And what's interesting about it is usually the more time you spend in front of the screen, the more things you're going to do.
Yep.
And the less effective you are, exactly. Because you're seeing all these flashing
and you're
lights
going
and
off
numbers.
your plan. You're going off your plan.
Yep. you start acting emotional to those, and you start saying, well, I'm going to catch this and I'm going to do that. So I've just set my plan of I trade late in the day. That's where I take action.
Now,
the reason I like to do it late in the day is because my philosophy, the theory is that by the end of the trading day, everyone has been able to put in their 2 cents, right? They've been able to execute their expectations. So if a big fund manager has been doing things,
they're getting settled for the close too. They're getting everything tied up.
Yep. And so I've got a sense of, okay, this stock is rolling over. This stock is breaking out. By the end of the day, I can see that. Early on in the day, you can have some kind of helter-skelter moves that aren't necessarily going to have as much follow-through as a lot of times later in the day. So that's the strategy that I work off of. Now I execute my trades. If I have time later that night, I might go through a few charts or look at a couple of fundamental things that I wanted to look at. I'll do some work on the weekends. Every weekend, I definitely set a game plan of, and I'll put it in my phone. I'll actually set reminders. The FOMC meeting is on Wednesday.
Right.
I'll just set a couple of calendar items of the big events and then kind of build a game plan of, here's some stocks that I'm going to be watching. Here's the price levels that I'm going to be watching closely. And I'm done. I don't spend. It's interesting. The longer I've traded, the less time I've spent inside of the markets. Mm-hmm. Whereas early on, I wanted to kind of watch everything and drive myself crazy. The more knowledge goes up, the lower risk becomes and the lower your fear becomes as well. I'm not fearful of anything the market's going to do today. Or tomorrow or the next day, I can take advantage of it, and I have risk management in place, so I don't have to be in front of the screen watching every price change and worrying about it. And so that gives me freedom of thought, freedom of opportunity, and that's the way I like to go about my day.
Knowledge without this is not going to do it. Knowledge without this is not going to do it. I'm just going to tell you. Now, I didn't write down some of Corey's habits because I think they're the best habits for someone to have. I just wanted to write them down so he has them. Hey, if you want to trade at a different time of day and it's dedicated, I don't think it matters so much that you're just consistent. To tell you the truth, I do most of my work when the market's closed. I do most of my planning, most of my work when the market's closed. And you can set triggers for stuff when the market opens to get into stuff. Yeah. So that's a great book. I recommend it. Power of Habit learns about cues, learns about how to change a behavior on the cue, learns how your brain works. And, habits are just things that you do. That's the actions you take. That will determine whether or not this plan gets done, and that determines whether or not this happens. So a good session. Begin with the end in mind. Set goals to set up yourself, family, your legacy, whatever they are. Make sure that, I got to capitalize that, make sure that you approach risk not only from an investment standard of getting good investments, but becoming a better investor. And then choose your team wisely, get your goals and make your plans, but then develop your habits, because all the knowledge in the world doesn't work well without great discipline and habits. I would say the more I trade, when I look at the times where I've screwed up the most, either the wrong action or a lack of action, it's because of a bad habit and changes that needs to have in the habits. Anything you want to say on that, Corey?
Yeah, I think that's it. I mean, it's really, habits can be good or habits can be bad, right? And so you'll recognize as you're paper trading, you'll say, I kind of have a bad habit for doing this, overreacting to that or whatever it may be. So write that down in your trading journal and say, I'm going to work on this. And what's interesting is if you work on it, your worst habits will become your strengths. And I've seen that in my life. The things that you maybe didn't like before, that you can turn those into your strengths. And that is just an absolute truth, is that if you'll work on it, what you didn't do well before, you can get better and better at it, and it can become a strength. And so that's kind of the light at the end of the tunnel, is even if you say, well, I've got to, I get too emotional about money, it can become a scenario where you can literally turn that into your strength, where you no longer worry about it and you have a complete kind of disconnect from worrying about it, because as knowledge goes up, your risk and your fear
down.
and those things go down. So it's a wonderful thing.
Okay, so one of the great habits that, and this is a good segue, one of the great habits that you'll have is the trading journal. So we're going to talk about getting a trading journal in the next segment. This was a shorter class, very important one though. And again, all these preparatory classes, you can go through every single one of them and say, okay, true or untrue. This is something I want to have before I actually go live trading options. And they're just all the things that I wish I'd have been taught before I got into the nuts and bolts are going to actually be a lot easier than you think. It's going to be consistent the way you're going to learn them. We've outlined this very consistently in how we've taught it, and how we're going to teach it. It's going to be fantastic. So great job on thinking about your plan and where this option trading is going to fit in your overall wealth plan.